The Social Security Administration is on track to raise your monthly check in 2027. Current projections put the COLA increase between 2.8 and 3.2%. For the average recipient, that is roughly $57 more per month. And on the surface, that sounds like good news. It is not. And by the end of this video, you will understand exactly why a bigger COLA number is a warning signal rather than a win, what is actually driving it up this year, and what the math says you should be doing with your money right now because of it. Let us start with how the COLA works, because most people do not actually know the mechanism. The Social Security Cost of Living Adjustment is calculated once a year using a specific measure of inflation called the Consumer Price Index for urban wage earners and clerical workers, or CPIW. The Social Security Administration looks at CPIW data from July, August, and September, compares it to the same 3 months the prior year, and uses that percentage change as the following year's benefit increase. The final official number for 2027 will be announced in October of 2026. Right now, we are in early estimates territory, and the two most tracked analysts are the Senior Citizens League, projecting 2.8%, and independent analyst Mary Johnson, projecting 3.2%, driven by rising gasoline prices. Both numbers are higher than the 2.5% COLA that took effect in January of 2026. Here is the problem. The COLA is designed to help Social Security benefits keep pace with inflation, but it measures a specific basket of goods weighted toward urban workers, not toward what retirees actually buy. Retirees spend a disproportionate share of their income on health care, housing, and food. Those categories have been rising faster than the overall CPIW for years. A 2026 study by the Senior Citizens League found that Social Security benefits have lost 20% of their purchasing power since 2010, even with COLAs applied every single year. Every year the COLA goes up, prices went up more. But this year, there is a new driver making that gap worse, and it is the story nobody is connecting clearly. Tariffs. The tariffs introduced over the past year have pushed consumer prices higher across specific categories. The Yale Budget Lab, which has been tracking the economic effect of tariffs in real time, calculated that the average American household will spend $570 additional in 2026 due to tariff-driven price increases. Non-durable goods, the category that includes clothing, food, household supplies, things retirees buy every single week, are up approximately 5.6%. The San Francisco Federal Reserve published analysis in March of 2026, confirming that tariffs are passing through directly into consumer prices as pre-tariff inventory buffers run out. Here is what that actually means for the math. The 2027 COLA is going up, partly because tariff-driven inflation is pushing the CPIW reading higher. So your Social Security check goes up $57 per month. But your grocery bill, your prescription costs, your electricity, your everyday expenses are going up because of the same tariff inflation that triggered the raise. You are receiving compensation for the price increase and paying the price increase at the same time. The net gain is far smaller than the headline number suggests, and in some spending categories, it is no gain at all. This is the part of the COLA story that does not make the headline. There is also a secondary problem that will hit some recipients specifically. It is called IRMA, the Income-Related Monthly Adjustment Amount, and it affects Medicare Part B and Part D premiums. If your income crosses certain thresholds, your Medicare premiums go up. Those thresholds are adjusted periodically, but not always in sync with benefit increases. The standard Medicare Part B premium rose to $185 per month in 2026, up from 174.7 inches 2025. If 2027 brings another premium increase alongside the COLA, part of that $57 raise disappears before it reaches your bank account. Social Security recipients who are enrolled in Medicare have their Part B premium automatically deducted from their monthly benefit. The net deposit is what matters, not the gross increase. Now here is where the 2032 number comes back in. The Congressional Budget Office updated the Social Security Trust Fund depletion estimate to 2032, 6 years. The Social Security Fairness Act added $17 billion in retroactive payments. Recent tax changes reduced payroll revenue flowing into the fund. And tariff-driven inflation, while it pushes COLA estimates higher, also increases the cost of every benefit payment the SSA sends out, accelerating outflows from the fund. A higher COLA is not neutral to the trust fund. It is additional pressure on a system that is already projected to face a 23% automatic cut in 2032 if Congress does not act. A bigger raise today and a faster depletion tomorrow is not a trade you want to celebrate. Here is your practical checklist for what to do right now. Step 1. Recalibrate how you think about the COLA. The right question is not what percentage your benefit is going up. The right question is whether your total monthly income is keeping pace with what you actually spend. Track your real expenses against your income, including Social Security, any pension, any distributions. If the gap is widening despite COLAs, that is the signal that matters. Step 2. If you have not yet claimed Social Security, understand that delaying your claim still builds the base that all future COLAs apply to. Every COLA percentage is applied to your benefit amount. A larger base means every future adjustment produces a larger dollar increase. Claiming at 70 versus 62 is not just an 8 years times 8% calculation. It is a permanently higher base that compounds through every future COLA for the rest of your life. Step 3. Look at your Medicare situation specifically. If your income is near the IRMA threshold, review whether any year-end income moves, Roth conversions, capital gains, or distributions could push you into a higher premium bracket in 2027. The income used to calculate 2027 IRMAA is based on your 2025 tax return. That year is already closed. But 2026 planning decisions affect 2028 premiums. This is the kind of multi-year calculation that rarely gets explained clearly. Step 4. Take the tariff inflation number seriously in your household budget. The average $570 annual household cost is an average. If you are a retiree living on a fixed income and spending more of your budget on food, clothing, and household goods than the average working-age household, your personal tariff exposure is higher than $570. Run your own numbers against what you actually buy. Step 5. If you have savings outside of Social Security, the tariff inflation environment makes the case for I-bonds and short-term TIPS, Treasury Inflation Protected Securities, stronger than it has been in the last 2 years. These instruments adjust with inflation. In an environment where official inflation is 2.7%, but real costs for retirees are running higher, inflation-protected assets are a straightforward hedge that most people are not using. Step 6. Start watching October. That is when the official 2027 COLA announcement comes out. Watch what happens to Medicare premiums in the same window. The net effect, benefit increase minus premium increase, is the real number that changes your monthly income. Most news coverage will only report the gross COLA. Do not mistake the headline for what actually lands in your account. A higher Social Security COLA in 2027 is real, but it is being driven by the same inflation that is raising your prices, and it arrives in the same year that Medicare premiums are likely to increase again, against the backdrop of a trust fund with 6 years left before automatic cuts. The raise is not a reason to relax. It is a reason to update your numbers. This channel will keep breaking down the real story behind the headlines. No drama, just what is documented and what it means for your money. If this helped, subscribe so you catch the next one. This video is for informational purposes only and is not official Social Security or financial advice.